Hey everyone, welcome back to the channel. If you're new here, this is where we don't just watch charts. We decode the psychology, the liquidity, and the political theater that actually push them around. And if you've been here before, welcome back. You already know the drill. We don't predict, we position. What if I told you the most fascinating market in the world right now is also the most politely confusing? Japan's Nikkei is not sprinting. It's gliding, printing fresh post-bubble highs while everyone at the party swears they're not the one topping up the punch. It's the kind of rally that makes economists uncomfortable and traders curious. And right at the center of it is a date that looks harmless on a calendar, but very loud on a Bloomberg terminal. October 4th, the Liberal Democratic Party leadership election. New leader, new prime minister, and possibly a brand new narrative premium. That's what we're trading. Not just earnings, but the next chapter title. Let me start with the part everyone pretends to understand. If you look at the Tokyo Stock Exchange's weekly investor flow data, the punchline lands with a straight face. Since late July, foreign investors, usually the main characters in any Japanese bull market, have been net sellers to the tune of around 1 trillion yen. Retail investors? Also net sellers, roughly 2 trillion yen. Corporate buybacks? Present, but not historically outrageous. And yet the Nikkei keeps rising. So who's doing the heavy lifting? The honest answer is that expectations are doing it. When sellers believe liquidity is coming, they stop being brave. Prices don't just rise on buyers, they levitate on hesitation. And what exactly is everyone hesitating for? A political catalyst with an easy label, Takaichi trade. That's the market's nickname for a scenario in which Sanae Takaichi becomes prime minister and keeps the fire hose of policy comfort wide open. Not because she published a 1,000-page fiscal blueprint, but because her tone signals a preference for aggressive fiscal outlays, a friendly stance toward continued monetary accommodation, and a focus on economic security, defense, energy, food supply, cyber, national resilience. In trader English, that translates to weak yen tolerant, Nikkei friendly, and not in a rush to step on liquidity. Here's how that plays out on desks from Marunouchi to Mayfair. Exporters smile because a softer yen adds easy oxygen to earnings. Autos, machinery, trading houses, classic beneficiaries of the FX translation effect. Defense names catch a bid because economic security is budget code. Semiconductor supply chain names, equipment, materials, metrology, attract capital because Japan's edge is selling the shovels into multiple chip gold rushes. Construction and civil engineering inch up because national resilience almost always means concrete you can photograph. Energy and the power grid gather a quiet tailwind as policy talk turns to storage, transmission, and capacity. Cybersecurity sits in the shadows until a single line about critical infrastructure protection nudges large orders into very small floats. None of this is ideological. It's behavioral. Markets are not scoring manifestos. They are guessing liquidity. And for now, the guess says, she won't choke the hose. But it's a 3-act play, not a one-woman show. So let's run the tape for Shinjiro Koizumi. Young, camera-ready, an international magazine editor's dream. He speaks in the language of modernization, cost of living relief, wage momentum, tax cuts, reform, and the headline-friendly 135 trillion yen in domestic investment by 2030. Sounds big, looks bold. The question traders ask is small and cold. Is this front-loaded, funded policy, or inspirational wallpaper? If it's the latter, if the first messages are vision without near-term yen flow, expect what the street will immediately nickname the Shinjiro shock. Not a crisis, a repricing. Hope gives way to ambiguity. Ambiguity gives way to profit-taking. Weak yen beta pockets, autos, and global cyclicals cool first. Defense pauses while budgets are clarified. Liquidity darlings deflate. Then the market waits for numerals. Sector buckets, yen amounts, timelines, and what gets pulled forward. If those arrive with Modernization can rally in Act 2. Agri-tech, industrial automation, green power kit, recycling and waste to energy, grid-side tech. If they don't, funds keep their gross light and their attention elsewhere. Charisma is wonderful for press conferences. It is not a factor in a discounted cash flow. Now for Yoshimasa Hayashi. The outcome professionals secretly fear because it's not a signal, it's an absence. Competent, steady, experienced, great for governing, terrible for storytelling. There's no liquidity myth, no youthful shock, just continuity. Markets don't usually crash on continuity, they decay. Liquidity doesn't flee, it gets bored. Volumes thin, indices drift, and without a narrative, traders begin to outsource conviction to moving averages. If the Nikkei and topics meander and then slip below a widely watched line, say the 13-week moving average, you can trigger mechanical degrossing from funds that promised themselves they wouldn't overthink Japan again. A crash gives you clarity. Boredom gives you decay. That's the Hayashi risk. Let's put some numbers into the air to ground the mood. Dollar-yen trading between 146 and the high 149s is not just a conversion rate, it's a regime. Under the mid-140s, central bank language is doctoral. Around 150, the nouns get heavier, undesirable, excess volatility. Above that, the market begins to whisper the words coordination and intervention, even if officials don't. Exporters love the soft currency. Households pay a quiet tax at the supermarket. The political equilibrium everyone seeks is simple. Let the Nikkei keep smiling and offer just enough subsidies that households grumble but don't revolt. If that balance holds, the weak yen trade can hum along without many speeches. On the Bank of Japan, forget Hollywood. Japan doesn't slam rates. Japan edits sentences. Policy here is written in eyebrows. Monitoring conditions becomes excessive moves, becomes undesirable, becomes prepared to act if necessary. Traders don't need to forecast 160. They need to recognize when language moves a half step and positioning should move a whole one. In a leadership transition where fiscal energy is likely to be the loudest instrument, BOJ restraint is the most powerful tacit stimulus. Silence is permission, until it isn't. Let's do this like a real Sunday night risk meeting. Defense. Budgets are trajectories, not events. If the new administration emphasizes national security, procurement pipelines thicken. You're not buying one quarter, you're buying the committee process that writes multi-year contracts. The cost is boredom. The reward is inertia. Semiconductors. Japan's role is leveraged to the tools, gases, wafers, polishers, and inspection systems that everybody everywhere needs. In a world of friend-shoring and de-risking, that's durable optionality. The cleanest way to express it is often the least glamorous ticker. Infrastructure and national resilience. Bridges, levees, ports, tunnels, data center power, flood defenses. Ribbon-cuttable, vote-friendly, visible. These don't gap up on headlines. They trend with policy momentum and then one day feel expensive, which is usually code for we forgot they were compounding. Energy and food security. LNG logistics, grid storage and transmission, demand response tech, controlled environment agriculture. 2 years ago, this sounded like a policy seminar. Today, it screens as a portfolio core for allocators who don't want to be surprised by geopolitics again. Cybersecurity, the invisible line item. The government won't hold a press conference with vendor logos. But if strategic documents spend an extra paragraph on critical infrastructure, the contract pipeline quietly fattens. It's hard to trade on headlines. It trades on procurement. Baskets beat heroic single-name bets. Exporters. Vehicles, construction machinery, precision instruments. Every 1 yen of weakness is worth some mix of translation help and analyst mood improvement. It's not just the P&L, it's the confidence that slips into guidance. Domestic consumption is the honest part of the story. Weak yen plus imported inputs equals higher costs. Subsidies can bridge but not repeal arithmetic. If the government times relief well and targets it, domestic names can grind higher. If not, they lag, while the export engine gets the applause. We need to talk about a risk that gets waved away until it doesn't: financial income taxation. The largest opposition party has already said, with TV-friendly clarity, that lifting the current roughly 20% rate toward 25% is possible. You can argue the merits, the fairness, the revenue math. The market hears a different word: signal. If the governing coalition needs opposition cooperation to pass anything big, tax headlines become bargaining chips. Funds don't wait for legal language, they react to credible political sourcing. The first real headline about a framework discussion is your cue to cut gross, not your chance to tweet an opinion. There will be denials, premature remarks, clarifications, and editorials. When the third or fourth article lands and positioning has cooled, that's when you reassess. Trade the silence between the sirens. Let's stitch the scenarios into something you can actually act on. If Takaichi wins and her first 100 days sound like she campaigned, Aggressive supplementary budget, economic security front and center, no early worship at the altar of discipline. The Takaichi trade has time left on the clock. That means buying exporters on dips, not headlines. Letting defense trend, not sprint. Owning semis through the supply chain where the hype is lower and the duration is longer. Holding a boring sleeve of grid and construction so you can sleep while the indices argue. Watching dollar-yen as a behavior threshold, not a prediction tournament. If BOJ tone hardens or cabinet language leans into balance, trim with no apology. If Koizumi wins, acknowledge the risk of a handsome pullback. Let the hope unwind. Don't be a hero. Then listen like a bond trader for nouns and numbers. When he names sectors, attaches yen amounts, and front-loads timelines, modernization becomes tradable. Equipment makers, automation, efficiency retrofits, agri-tech, recycling, and waste-to-energy can run. If he leans on reform without checks attached, patience is a position. If Hayashi wins, assume the index loses its story premium. That's not bearish, it's nuanced. Single-name alpha matters. Dividends and buyback cultures matter. The 13-week moving average matters because other people will pretend it does. Keep a list of names you want to own when boredom manufactures a better entry. Across all paths, keep one fire drill at the top of the desk. Credible financial income tax headlines equal immediate de-risk. Not forever. Just long enough for the market to test how brave it wants to be when after-tax returns are in the rumor mill. A word on the sociology of 150 in the currency. It's not the number, it's the conversation. Below it, officials read white papers. Above it, they read the room. Exporters model differently. Households feel it. Journalists get creative with synonyms for concerned. Use that to time your courage, not to audition as a prophet. There's also the meta story no one wants to say plainly. Japan's market doesn't just trade earnings, it trades international attention. A first woman prime minister would carry symbolic premium in global allocators' decks, especially if paired with fiscal largesse and an assertive security posture. A 40-something prime minister would print glossy covers and invite a youth premium if numbers show up. A competent continuity prime minister would reassure diplomats, but that reassurance does not have a ticker symbol. History matters most to markets when it arrives with a budget. So where does that leave us? With a rally that rose O's on corporate discipline, narrative oxygen, and the expectation of policy comfort. With 3 political paths that rhyme with liquidity in very different ways. With a currency that doubles as a national mood ring. With a central bank that moves markets by moving adjectives. And with a single headline risk that can erase a week's gains without changing a single company's product. You don't need to predict the winner. You need to recognize when the story shifts. Liquidity builds rallies. Language kills them. The bell at the top rarely rings. It whispers through a policy leak. A crash gives you clarity. Boredom drains you slowly. Japan does not always move on spreadsheets. It moves on tone, optics, and the collective willingness to keep pretending we understand who is actually buying. If this helped you see the moving parts more clearly, or at least made you smirk at how markets truly behave, hit like so the algorithm doesn't wander off during a Hayashi-style drift. Tell me in the comments which path you think the market is secretly pricing right now. The Takaichi trade, the Shinjiro shock, or the Hayashi hibernation. Subscribe if you want more macro told like a story rather than a spreadsheet. And next time, let's really test the narrative machine. What happens if the Bank of Japan actually hikes and nobody believes them? I'll see you then.